A person can be worth hundreds of billions of dollars and still pay almost nothing in income tax in a given year. And the crazy part is, that does not necessarily mean that they broke the law or found some secret illegal loophole. And in a lot of cases, that's just the tax code working exactly the way that it was written. And recently, this whole thing became a bigger conversation again because Jeff Bezos went on TV and basically said this whole buy, borrow, die strategy is fake, while senators like Elizabeth Warren and Ron Wyden have been talking about changing the rules because they say it is very real. So in this video, I want to walk you through how this actually works, where the internet tends to exaggerate it, and the part of this strategy that normal people can actually learn from, even if you're not sitting on a few $1 billion of Amazon stock. Okay, the real reason this actually matters is not because most of us are gonna wake up tomorrow and start borrowing $10 million against our stock portfolio. That is obviously not the world that most people are living in. But once you understand how wealthy people structure their money, you start to see that they are playing a very different game than someone who only earns a paycheck. Most people work, get paid, pay taxes immediately, and then try to build wealth with whatever is left over. The wealthy tend to do it in a different order. They first own an asset. Those assets grow, and they figure out how to access money without always triggering a huge tax bill right away. And once you see that difference, the whole how do rich people pay so little in taxes question starts to make a lot more sense. It's not magic. It's not always some secret backroom trick. And a lot of times it comes down to three basic ideas. They own, they borrow, and eventually they pass those assets on. The first thing to understand is that most extremely wealthy people do not build their wealth from a normal paycheck. That is a big difference because the way that you and I earn money from a job, that income gets taxed pretty quickly. You work, you get paid, taxes come out, and by the time the money hits your account, the government has already taken its fair share. And at the highest levels, ordinary income can be taxed at a much higher rate than long-term investment gains, which is one of the biggest reasons the whole system favors people who own assets instead of only earning wages. But someone like a founder of a huge company does not usually become worth billions because they are taking a massive salary every 2 weeks. Their wealth is usually tied up in stock. They own a company or they own shares of a company, and as that company becomes more valuable, their net worth goes up. But here's the key part. If something you own goes up in value, you usually don't have to pay taxes on that growth until you sell it. Think about your house for a second. If you bought a house for $300,000 and then a few years later it's worth $400,000, the IRS doesn't just send you a bill just because Zillow says your house went up in value. You haven't actually sold it yet. So you're richer on paper, but you have not locked in that gain yet. Stocks work in the same way. If a founder owns billions of dollars of a stock, and that stock goes way up, they can become massively wealthier without creating taxable income because the tax usually does not show up until they sell. So that's step one. They own things that grow, and as long as you don't sell, they can often delay the tax. That's where step two comes in. Instead of selling stock and triggering a tax bill, some wealthy people borrow against their assets. A bank looks at their portfolio, sees that they have a massive amount of stock or other investments and says, yeah, sure, we're willing to lend you money because those assets can be used as collateral. This is what's called a security-backed line of credit. And the easiest way to think about it is probably a home equity line of credit. If you own a home that goes up in value, you may be able to borrow against the equity of the home without selling it. You get access to cash, but you still own the property. This is really the same basic idea, except instead of borrowing against a house, they're borrowing against a stock portfolio. And the reason this matters so much is because borrowed money is not treated like income. If you borrow money from a bank, you do not pay income tax on the loan proceeds because technically that's not money that you earned and it's money that you have to pay back. So if a founder sells $10 million of stock, that sale could create a taxable event. But if they borrow $10 million using that stock as collateral, they now have that cash they can use while still keeping the stock invested. That's the part people are talking about when they say the rich borrow instead of sell. They get access to money, they avoid selling the asset keeps growing, and they may be able to delay the tax bill for a very long time. But this is also where a lot of videos online start to make it sound way cleaner and easier than it actually is. Because yes, this strategy does exist, but it's not exactly free money forever either. The first thing people leave out is that borrowing money is not free. You do have to pay interest on it. And a few years ago, when interest rates were extremely low, this strategy looked a lot more attractive because wealthy borrowers could often access money at super low rates. And that is where some of the "they borrow for almost nothing" narrative came from. But it's not actually the same world we're in now. Rates are a lot higher, and even though the ultra wealthy may get better terms than a normal person like you and I would, that money still has a cost. For a regular investor trying to use a securities-backed line of credit today, that rate could easily be in the high single digits depending on the lender, the size of the account, and where the benchmark rates are at that time. So this is not just free cash falling from the sky. although that would be pretty cool. The second thing people get wrong is that it's not necessarily how every billionaire funds their entire lifestyle. That's the version that goes viral because honestly, it just sounds outrageous. The story usually becomes billionaires never sell anything, they just borrow money forever, buy whatever they want, and they never pay taxes. But the real world is usually messier than that. Some wealthy people absolutely use loans against assets, but that does not mean that every dollar they spend comes from tax-free borrowing. If you borrow against a stock and that stock drops hard enough, the bank can ask you to add more collateral or pay down the loan. And if you cannot do that, they can force a sale. That means you could end up selling the exact asset you were trying to hold at the exact time you least wanted to sell it. So this strategy can be really powerful, but it can also go very, very wrong. It's not a life hack, but it is leverage, and leverage always cuts both ways. Now, the other side of this conversation is that wealthy people still do pay taxes, and sometimes they pay massive amounts. A good example is Elon Musk. In the year that he sold a large amount of Tesla stock, he reportedly paid around $11 billion in taxes, which was described at the time as one of the largest individual tax bills in US history. So when people say the rich never pay taxes, that's just a little too simple. Those huge tax bills usually happen when they sell, exercise stock options, or create some other taxable event. In a year where they don't sell, their income tax bill can look completely different. And that's why someone can be one of the richest people on the planet and have their net worth go up by billions of dollars, but still show very little taxable income for that year. Their wealth has increased, but the tax code does not usually tax wealth just because it went up on paper. It taxes income and it taxes gains when those gains are realized. And that's the key difference. It's not always that they never pay taxes, it's that they often have more control over when they do pay those taxes. And that ability to choose the timing is one of the biggest advantages in the entire system. Okay, now we get to the final part, and this is where the whole strategy gets its name. Buy, borrow, die. The buy part means is that you own assets that grow. The borrow part means that you borrow against those assets instead of selling them. And the die part of it is where the tax treatment can get really powerful. Under current law, when someone dies and passes their assets on to their heirs, those heirs often receive what's called a step up in basis. That sounds super boring, but it's a really big deal. Now let's say someone bought a stock decades ago for $1 million. And by the time they die, that stock is worth $100 million. Normally, if they sold it while they were alive, they could owe tax on the $99 million of gain. But if they hold it until death, and their heirs inherit it, that cost basis may reset to the value of the date of death. So instead of their heirs being treated like they bought it for $1 million, they may be treated like they received it at $100 million. That means all of that growth happened during the original owner's lifetime can essentially disappear for capital gains tax purposes. Their heirs could sell the stock, use some of that money to pay off any loans that were taken out against it, and owe little or nothing in capital gains tax on the lifetime growth that happened before they inherited it. That is why this strategy is so controversial. Because if everything lines up, someone can buy an asset, borrow against it for years, never sell it during their lifetime, and then pass it on with a stepped up basis. And at that point, a lot of the tax that would have been owed if the asset had been sold during the life can basically vanish. And that's the full loop. You buy assets, borrow against them, hold until death, and then let step-up basis do the final piece of the work. Now, obviously, most people watching this are not going to use the billionaire version of the strategy, and honestly, most people probably should not try to either. Borrowing against investments can be risky, and if you do not fully understand what you're doing, it can go sideways really fast. But I do think that there's a useful lesson underneath all of this. The real lesson is not go borrow against your stock portfolio. The real lesson is that ownership is treated differently than earned income. If all of your money comes from a paycheck, you are in the most heavily taxed and least flexible part of the system. You earned the money, taxes come out, and then you try to build wealth with what's left. But when you own assets that grow over time, whether it's an index fund, retirement accounts, real estate, or a business, you start to benefit from the same basic rule that wealthy people use. You do not owe tax every single year just because your investments went up. If you hold investments long enough, you may qualify for long-term capital gains rate, which are often lower than ordinary income tax rates. And if you use retirement accounts like a 401k, an IRA, or a Roth IRA, you may be able to delay taxes or avoid taxes on future growth, depending on the type of account. That's the normal person version of this lesson. There are no yachts, there's no private banks, you're not borrowing tens of millions of dollars against stocks. Just owning more things that can grow and relying a little less on income that gets taxed at the moment that you earn it. That shift does not make you rich overnight, but over decades, it can make a massive difference. And if you're starting from a normal income, the boring version is probably the better version anyway. Buy assets consistently, hold them for a long time, use tax-advantaged accounts when they make sense, and do not confuse a strategy that works for billionaires with something that is not automatically smart for everyone else. If this video helped make the billionaire tax conversation a little easier to understand, be sure to get subscribed to the channel because I break down money, real estate, and personal finance every single week. And let me know down in the comments which part surprised you the most, because I'm curious if it was the borrowing part, the step up in basis, or just the fact that this is basically how the rules are written.